You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for today's show is a real estate investment expert and managing partner of Gelt Inc, Keith Wasserman. Keith founded Gelt Inc. in 2008 during the height of the recession and financial meltdown. Keith has been involved in the acquisition of several commercial, industrial, and residential properties totaling over $1 billion in assets. He oversees the company's operations, marketing, investor relations, acquisitions, leasing, development, and disposition services. In addition to his commercial multifamily activities with Gelt, Keith recently co-founded Happy Home Communities, which focuses on the manufactured housing niche. And so with that, guys, I'm looking forward to diving deep into Keith's business to find out how he's been able to build a real estate company with more than $1 billion in assets under ownership in less than 10 years. In addition, I'm excited to find out more about his recent entry into the manufactured housing space because obviously, guys, you guys know that's the space that we're in. So I'm excited to talk to him about that. But before we get into the meat and potatoes, just have a few housekeeping items I want to run through with you. First off, as you guys are aware, just like I mentioned, we specialize in mobile home parks. That's our niche, manufactured housing. Mobile home parks, kind of one and the same. And I only tell you this because if you didn't know, we're always looking for new opportunities, okay? So if you're out there in the hunt, whether you're in the manufactured housing space or looking for multifamily or looking for, fourplexes or duplexes, whatever it might be, you're out there in the hunt, you run across a mobile home park opportunity, we want you to think of us, okay? If it's something that is at least 60 spaces in size and you just don't know what to do with it, and you think it might be a good opportunity, shoot me an email, reach out to me, let me know about it. We're open to joint venture partnerships. We're open to paying big finder's fees for good opportunities. We're open-minded about anything, okay? We're just always looking for good opportunities. So if you have something or you think you have something, shoot me an email directly, kevin@kevinbupp.com, and let's have a discussion about it. Next up, guys, if you're an avid listener to the show, then you've heard me mention this over and over and over again. So sorry for being redundant, but the investment arm of our company, we don't mention it a lot on the show, this little introduction, is Sunrise Capital Investors. And we own and operate mobile home parks throughout the eastern half of the U.S. And we partner with accredited investors who are seeking passive income on their money. Okay. And I mention this only because we just recently closed out our very first successful Reg D 506C fund and have had to reluctantly turn away a number of you who had shown interest. And just want to apologize for that. I'm sorry for those that we've had to turn away, but don't want you to fret because we are currently in planning mode for fund number 2. And so if you missed out on that very first fund and you have an interest in learning about what we're all about and potentially partnering with us on this future fund, please go to our website, sunrisecapitalinvestors.com, and you can create a free account inside our investment portal. This will basically place you on the first to know basis. You'll get on our first to know list for when fund number 2 rolls out. And just based on the demand for that first fund, we're expecting to fill the subscriptions very quickly. So just get on the list. Even at this point in time, you can even go in there and download some of our previous investment documents and kind of review, what we're all about, what we're doing. Just good free reading. So go ahead and create that free account. It only takes like a minute or two to do so. And then again, you'll be on that first to know list. Lastly, guys, if you happen to be in the Tampa Bay area, I'm based in Clearwater, about 30 minutes from the airport, and you got some time during your visit, I'd love the opportunity to meet up with you. You just shoot me an email to, again, kevin@kevinbupp.com. That is my personal email. Let me know what your plans are when you're coming into town, and let's see if we can coordinate a time to grab a coffee, a lunch, beer, whatever it might be during your visit. And guys, so without further ado, I'd like to welcome Keith Wasserman to the show. Keith, you still there, bud?
I'm still here.
All righty, good deal, man. Well, welcome. Keith, I have to tell you that I spent some time on your website, and I'm blown away. And then you and I talked for a few minutes before we started recording the show, and what you've been able to accomplish, and I know it's just not you alone, it's a team, right? We're not like one man on an island, but what you and your team have been able to accomplish in really less than 10 years is just astounding. It's quite impressive. I mean, $1 billion under ownership and management. I mean, that's incredibly impressive. So what I'd love to do, Keith, is number one, I want to learn how to find. I want to find out how you guys did this. Okay, I want how you built this company, how you put it all together. Before we get into that, I want to learn a little bit more about you, the person, like who you are, what your background is, and how you even got into this business.
Yeah, definitely. So first off, Kevin, glad to be on the show. And yeah, I've always been very entrepreneurial. I want to say I'll take you back all the way until my first entrepreneurial venture when I was 10 years old. My parents would take me to Costco and we would buy boxes of candy bars and, buy them wholesale and then sell them retail. I would go to the park and sell them one by one. And I learned from age that you really make money on the buy. And, later on when I was 15 years old, I bought around 500 leather jackets. They were ours, called irregulars. They had little blemishes on them. Not really noticeable unless you look really closely. I spent around $10 to $20 a piece and then went and sold them for $100 a piece. So again, making money on the buy. And then later on, when I was 19, I started my next business. It was called Keith's Bargain Center. We sold general merchandise on eBay. This was 2003. eBay was still fairly new and young, and started with one item, then two items, and started buying items. And over the last over 4 years, all through my college days, 2003 to 2007, we sold around 200,000 items on eBay, electronics, DVDs, clothing, etc. And it was all about also making money on the buy. So I've always been very entrepreneurial. Always, when people ask what I do, I say I'm a professional opportunist. So the real estate came to me it fell in my lap. My cousin, Damian Langeri, who's my co-founder, came to me with the opportunity to buy a 4-unit building in Bakersfield, California in December of 2008. So if we bring it back to that time period, the markets were in free fall, real estate prices were in the toilet, blood was in the street, and as an opportunist, I saw the opportunity to buy this fourplex that previously sold for $500,000, and we bought it for around $175,000. And the rents really didn't drop that much from the peak to the trough. So we were buying these buildings with immense cash flow in place. We learned by doing. We started, buying a fourplex, then another one, and we were renovating them and leasing them out, and just learned by doing essentially, and just jumped in hands first. Bakersfield is an hour and a half north of LA, so we were driving every week to Bakersfield, and it was just an amazing journey. And it's we built this business one property at a time, one investor at a time, et cetera. So.
Okay, very exciting, man. So it's funny because you bring back fond memories of entrepreneurism at a young age for me. In that, in 7th grade, it's all about the buy, right? But I used to buy bubble gum. I used to buy 5 packs of they came like 5 in a pack or whatever, and like they were like the big square pieces of gum that everyone loved when you're that young of age, and I'd buy them for $1.19 at the grocery store, and I'd go to school and sell each pack for $1. So I'd make like a $4 profit on a $1 buy. And the funniest part about this, Keith, is I actually got suspended. I got in trouble. I got 3 days of out of school suspension once the principal called onto my tactics, because I think I was affecting the business we had a school store. And so the school store, I think they saw a decline in their business. And so they put me on 3 days suspension, but that surely didn't stop me at that point. But I think I had it in my blood at a young age as well. So that's pretty cool to hear your story and how you came to be, into real estate. I mean, like you had a lot of different entrepreneurial ventures along the way. And so what I'd like to learn about is...
If the school was smart, they'd have you run the school store. That's
absolutely.
Encourage entrepreneurship instead of push it. So.
Well, it's funny. I was so scared when they called my parents and basically, had to tell them that, I wouldn't be coming to school the next 3 days. And it was because of that. And at that point in my life, I was scared to death. I was like, this is crazy. I'm in trouble for this. And I thought it was such a bad thing. I look back and I giggle at it now. Right. So I want to talk to you about.
Story.
Yeah, go ahead. Go ahead.
Sorry to interrupt.
No, go ahead. Go ahead.
When I was 13, I also got suspended for a couple days. I was day trading stocks. I was buying and selling stocks with my bar mitzvah money, and this was the height of the .com era. And I actually made tons of money doing it. And it's I sort of got in trouble for that as well. But
that's awesome.
In the long run, we both came up on top.
That's it. Good deal. So I want to talk about the introduction to real estate. So your cousin brought you an opportunity. It was a 4-unit property in Bakersfield. Prior to that, you had no real estate experience, right? I mean, did you own any rentals? Had you dabbled in this side of the business at all?
Yeah, so I graduated college in 2007, and I really didn't know what to do because I sold out all my existing merchandise for the eBay business because the margins kept getting squeezed. PayPal kept raising their fees, and I just had a lot more competition. So slowly liquidated that business. It was a great learning experience dealing with customers, employees, just running an entire business. And then, never had any real estate direct experience. My parents, my dad is an attorney, and my mom was a teacher for a long time. And then they in the late 80s, they started developing a couple properties. They own a small strip center here in Los Angeles, and they built a few industrial buildings, but they never have had any experience in the multifamily space. And but I tried to learn as much as I could in that one year of the business by reading as many books as I could. I wish podcasts were bigger back then. I would have listened to a lot of podcasts. And then, I whenever my dad had a meeting regarding his real estate investments, he's an attorney, but once in a while he had a meeting, I would go and attend and just be a fly on the wall and just listen and try to absorb it as much as I can and just try to be a student. But it's totally different once you're involved in doing. And I think, being involved and getting your hands dirty is the best way to, earn experience and learn. And, I kept my expenses low. I was 24 years old. I was still living at home. And for the first few years, it really didn't really make much money just because these were very small buildings and we had investors, but it really laid the groundwork to start, building, buying bigger buildings and putting syndications together and just learning the business. So definitely was a newcomer, but learned by doing. So.
You had to prove the concept, right? I mean, prove the concept on smaller properties before jumping into larger ones. And I want to learn about that proof of concept timeline. And so you guys were buying smaller unit properties, but more recently, I mean, you've grown a huge portfolio, and it's really made up of larger multifamily properties with a few other types of real estate dabbled in there. But talk to me about the timeline and how long it took to go from that first 4-unit property to a property that had much more substantial size to it. So 100 plus doors in size. How long did that take you guys?
Yeah, so great question. So December 30th of 2008, we bought our first fourplex, and literally a year later, we closed on our first apartment community that was 78 units. So all through 2009, we were buying the fourplexes until we were presented an opportunity to buy a 78-unit building also in Bakersfield, and all the fourplexes were in Bakersfield. So, really learning the local market and meeting with as many, business owners and local politicians and the brokers, and just really absorbing and learning the market.
Hey guys, Kevin Bupp here, and I'm sorry for interrupting the show, but I have something super important I wanted to share with you. I've been invited back for a second consecutive year as a presenter and panel moderator at the Best Ever Conference in Denver, hosted by Joe Fairless. Last year was an absolute blast, and the talent both on stage and in the room was nothing short of amazing, and this year, that talent has been stepped up a notch. Being that you're a listener to my show, I'd like to extend an invite for you to come and join me this year. The event is February 9th and 10th in downtown Denver, and seats are very limited. Use offer code KEVIN, my name, KEVIN, to receive 10% discount off the price of admission. The early bird registration is limited, and I guarantee that this event will sell out, so grab your tickets while you can. To learn more and to register, go to besteverconference.com. Now, I'm positive that once you take a look at the speaker lineup, that your mind will be made up and you'll be attending. And just to sweeten that pot a little bit, I'm going to be hosting a free real estate and mobile home park investing mastermind on Friday evening, free of charge for all who want to join. I did the same thing last year, and it was a huge hit, and I'd welcome the opportunity to meet with you and spend some time together to help you reach your real estate goals. If you want to partake in this mastermind session, you'll need to send me an email to kevin@kevinbupp.com and include proof of registration as well as your contact information. That way I will put you on the mastermind list. Again, go to besteverconference.com, use offer code KEVIN to receive a 10% discount off the price of admission, and I'll look forward to meeting you in February. Now back to the show.
So we were presenting with a 78-unit building. So instead of raising, we were buying these fourplexes cash pretty much. We couldn't get the financing, so we were raising $100,000 to $150,000 from pretty much friends, clients of my dad's, family members. So we raised for our first 78-unit building. We bought it for $3.9 million. We raised $1.3 million of equity, and we went to, I think, around pretty much 10 investors. So average check size of give or take $100,000. We reinvested our entire acquisition fee which was, I think, around $150,000 back into the deal. And thank God we did, because that was one of our best performing deals ever. I mean, we bought it for 3.9. We sold it like 4 years later for 6.5. We exchanged into another deal that we bought for $23 million. Just sold that for $35 million. So definitely, it was a great return for us and for our investors. And but it was a full year, getting just, and which seems pretty quick, but every day that was what we were doing, living, breathing. We were putting deals under contract, closing on them, renovating them, leasing them up, adding them to the portfolio, and getting them operating. And but the 78 unit was a great experience to take a community and that was neglected and breathe new life into it. We spent a few $100,000 renovating units. We had a second clubhouse that was totally closed down. We turned that into a gym. So we're on the first day we started buying buildings. We've always looked to add amenities and make the communities better for the people that live in them. Fixing deferred maintenance, making better curb appeal, landscaping, and then cutting costs. We saw there's a lot of these water leaks on the property. A lot of the sprinklers system was in need of repair. So we went through the property and cut the water bill substantially, and just doing a lot of little things, paying attention, and constantly keeping an eye on the property, and it turned out to be a real success.
Yeah, fantastic. And so during that first year and those fourplexes that you guys were buying, were you self-managing at that point in time?
So we outsourced to a few different local property management companies, and we weren't entirely happy, so we actually created our own property management company for our fourplexes, and we brought on a few other outside investors that owned other buildings that we managed, just because we needed some more economies of scale to make it pencil. Yeah. But after that experience, we have shifted away, and we outsource all our property management to third parties for all the apartments, just because there's so many. They do a better job in the markets we're in on the big buildings, but the small mom and pop management companies just didn't do a great job, and the big management companies wouldn't take on our little fourplexes, the same ones that take care of 100 and 200 unit buildings. So overall, it was and helped us keep our buildings full. And I think it would have been great if we lived there and kept growing that business. But I later on sold out of that business and just focused on growing our bigger properties and stuff.
Yeah, which is a beautiful luxury that you guys have in the multifamily space, which I'm sure you're probably starting to see some of the challenges with the manufactured housing space, which is the lack of third-party management companies that can do a quality job. And maybe you haven't experienced that yet. I don't know how many communities that you've purchased thus far, and we could talk about that here in a little bit. But I think that's one of the beautiful factors of commercial real estate, not just multifamily, but commercial real estate in general, that there are a lot of sophisticated third-party management companies that will do a much better job than you and I ever would, because they've got the systems and processes in place. They've got the economies of scale. They've got, thousands of units under management or millions of square feet of real estate under management, and they've got the infrastructure that would take a long time and a lot of money for you or I to try to build internally. And so I think that's one of the beautiful things about the multifamily space and why it allows you to scale a little bit faster, being that you can outsource that management. But I want to talk about that first 78 unit property. But more so, actually, I really want to talk about the market, Bakersfield. So you're an hour away. Bakersfield's obviously it's inland, correct? I don't know all my geography in California, but Bakersfield is inland, correct?
It's in the Central Valley, which is it's sort of like it's based on oil and agriculture, the economy. Okay. And most people in LA, if you ask them about Bakersfield, they don't even know exactly where it is. But it's a pretty thriving community. It's I think it's the 9th largest city in California and one of the top 40 or 50 in the United States. And we liked it because the price point per unit was very cheap, something we could afford. B, it was pretty close to our home. It wasn't like we needed to hop on a plane. And C, it just oil and ag would make it out of the recession pretty good. And it was one of those towns that they overbuilt on the single family, like a Phoenix or Vegas. And it was just reeling for a while. It got hit hard even before LA, and the prices dropped, dramatically. And we just thought it would be a good opportunity to come in. And, we didn't see as much rent growth in that market as a Phoenix and other markets that we've been in. We've since exited Bakersfield, but we still had great returns because we bought right, and cap rates have compressed, and we did get the NOI up, pretty dramatically, but not like we've seen in Denver and markets like that. So.
Yeah. Okay. So there were some underlying fundamentals of that marketplace. You guys just weren't buying there only because it was cheap, right? I mean, like there was actually supportive data that would state there's a demand for the type of housing that you guys were looking for, right? And there's
Correct.
industries to support
population growth. We were looking for population growth. That was one of the fastest growing cities. Affordability. It was a host of things, and definitely just it felt like a good place to start.
So let's talk about that first acquisition, the first big one, the 78-unit property. Because a lot of people that tune into the show, they're just, some of them have big portfolios already, but there's a lot of others that are just getting their feet wet, right? Or maybe they own a few rental properties today, and they'd like to own a 78-unit or larger type of building. And so I want to talk about that one because that was your first foray into larger apartments. The due diligence on a project like that is way different than it is on a 4-unit property. Lots of other differences along the way, financing, raising capital. I mean, just the price point alone, having to come up with that much money versus the $150,000 or $170,000 you were paying for these fourplexes. And so talk to me about that very first acquisition, some of the challenges you faced, lessons you learned, maybe things that you didn't even anticipate happening that became challenges. Can you speak to that a little bit?
Yeah, it was definitely a scary process, jumping in, into the deep waters and buying a bigger property. Thankfully, at that point, we brought in it was Damien, my cousin, myself, my father, we brought in who was an integral part in helping us get these bigger loans. I think that one we got a Fannie Mae loan on, and we wouldn't have qualified without my father, who has a bigger financial statement and has higher liquidity. All these loans, you have to have a certain amount of liquidity. And then we brought on another one that we called them the gray hairs, and someone that's been in the business for a long time that wanted to jump on board with a young, hungry group. So we brought on another partner. So it was really 5 of us, and we had another younger gentleman. So there's really 5 partners back in the day. Now there's only 3, but they sort of went their own ways. But yeah, we created a good team that, we didn't have the experience, but we had the hunger and work ethic and drive and new ideas. And, we utilized the gray hairs to help us get the purchase and help raise the money. It was tough convincing family, friends and clients of my dad's, but without them, we wouldn't be able to be where we are today. So
so you brought in the necessary support infrastructure needed. I mean, which is critical, especially when you're getting into this size of a property, especially in your beginning stage of your business. If you don't have a big track record, if you don't have a very strong financial statement yourself, you got to bring in these key players, these key sponsors that can help you get those types of loans and help you qualify and help you basically look safe in the eyes of the bank. That's what it really comes down to. Is giving them a comfort level that you weren't able to do on your own. So you strategically brought in others to help you to accomplish that.
Correct.
Yeah, fantastic. So that was a Fannie Mae loan, and then you said you just exited out of that one recently. And so was that an assumable loan? Did someone come in and assume the remaining term of that, or were you already terming out of that loan? Yeah,
so we are very conservative shop, and all the buildings we've bought, we have a plan to hold for the long term. We usually project a 10-year hold. We get 10-year fixed rate financing, and that sort of bit us in the butt a little, because as we've been selling selectively some buildings, they've had some high prepayment penalties, and rates have dropped even more. So the new buyers want to put on fresh debt. But the returns have been so huge, we're still just eating that prepayment penalty and still returning monster returns. So, but in all reality, our goal now is to really hold pretty much everything we buy for the long term and sell selectively, just to create some. We sold a lot of the buildings to create a good track record, to be honest, to show that we can do something full cycle, and our investors then put in that money plus more and tell their friends, et cetera. So it's helped us grow, I think, going full cycle. But in the long run, the way to create real wealth in real estate is to buy well-located buildings, run them well, and hold them for the long term. And we've been doing that recently. Instead of selling, we've put on supplemental financing and pulled out it's tax deferred because it's loan proceeds. So we've been doing that on a lot of deals rather than selling, to realize some capital back to our investors. And we have almost 500 individual investors now. They're all like you're dealing with, accredited. We have high and ultra high net worth, and they just started with 1, then 2, and 3, and it's really snowballed. And if you're able to make people solid returns and be very transparent with them, I think they'll respect that and trust you. And that's how we've grown this business pretty much.
Yeah, that's fantastic. And so how many doors are you up to at this point in time in the multifamily space?
Yeah, so we've acquired around 7,500 units, but we've sold around 2,500. So we're probably around 5,000. I mean, we give or take. But the goal is to grow to 10,000 in the next few years, and we'll be selectively selling probably once in a while a building here and there. But so it's going to be a lot quicker, I think, the growth. However, it is getting more difficult to find good buildings to buy that make economic sense as we're, later on in the economic upswing. It's been 9 years already now of growth. So real estate and business in general cyclical. So we always prepare for the worst, but hope for the best. And we mitigate our risk by getting those long-term fixed rate loans. We raise a lot of extra capital for reserves. So we were looking at buildings in Phoenix that were lost to foreclosure, and they were in great shape, but they over leveraged. They didn't have reserves. So when the rents dropped and occupancy dropped, they just weren't able to service their debt. So we're just trying to always mitigate our risks, and even if that means the cash return might be a little lower if we're raising more money up front. But I'd rather sleep at night and not be able to say we've never had to do a capital call, and I never want to do a capital call to our investors. So.
Yeah, I want to ask you something about your investors. So you started out with one, and like a small core group of investors. Have you found that there's been a snowball effect as far as your investor base growing by referrals of those initial core group, or has it been have there been a lot of fresh bodies coming in because of your touches, like your relationships? I mean, what's been the biggest source of growth of the investor database?
I'd say the biggest source of growth is from the referrals. So the family members of the investors, their close friends, people they do business with. A referral source is we have a lot of CPAs that invest with us, and then they have their clients come in, other professionals, and but it's just word of mouth, really. I mean, we're just all word of mouth, I'd say. And every deal we have probably 20 to 30% new money coming in from new investors, and then the rest from existing investors. We have a certain core group of investors that put a little money in every single deal. Some investors like to pick and choose, and then some, once they tap out, they earn some more income and then put some more back in. But I was, a proponent of diversification. I tell our investors, just don't put a lot of money in one deal, spread it out amongst a lot of deals, and don't put all your money in real estate in general. Keep some cash, put some money in the stock market, some bonds. But real estate should be in anyone's portfolio that's trying to build wealth, accumulate wealth, and have good cash flow. One mentor said time and inflation are real estate's best friends, and definitely it heeds well. So.
Yeah. So talk to me about the management side. I know you outsource your management now, 100% of it. Talk about some of the challenges of finding the right property management company, and do you guys diversify with the different management companies that you use, or is it one management company that manages all of your assets, or do you have selective management companies for different types of properties?
Yeah, so we use the best, I'd say, regional management companies. So we have one management company that's been our go-to because they happen to be in a lot of the regions, and they're doing a great job for us. They're very aggressive on the other income. They run a pretty tight ship. That being said, we're very hands-on with the management companies. We have weekly conference calls. We do unexpected site visits. We help, oversee all the major capital expenditures. We're very hands-on, but a lot of these bigger ones are very professionally run and give us good service. But in some markets, if they're not there, so I think we have like 4 different management companies we're working with now, and we have had to replace some in the past. And every management company, it has its quirks, and our asset managers, they probably prefer dealing just with one, but we want to be able to hire the best one that's most qualified in those different regions. And like I said, I get the question, why don't we do our management? We're leaving a lot of money on the table. I think if we did our own management, we wouldn't be able to grow at this speed. We would be focused on, hiring, training, and just, the management is it's a tough business. You have to have scale to make the money. And I think if we were all our buildings and we're in one area, maybe we would consider it. But we're so geographically just spread out. I think we're in 10 states now, so it just doesn't make sense. And like you said, apartment management companies, there's a lot of good ones out there. I don't think there's as many in the mobile home park space. but definitely for apartments there are right now.
So let's talk about that a little bit. Let's talk about your diversification into the manufactured housing space with, was it Happy Home Communities? Is that what the name of the company?
Yeah, Happy Home Communities, and for all intents and purposes, it has the same investor base. They're all individual investors in syndications, but we wanted to be able to brand it in case we did take in different kind of capital and maybe have a different business plan but just to keep our options open. So we're branding them as Happy Home Communities, and they're pretty much workforce. It's not really lifestyle communities we're buying. Where it's more workforce housing, affordable. Mm-hmm. We're going to have 10 parks pretty soon under our ownership, around 1,000 spaces, and there a lot of them are in the Northeast, in Pennsylvania. We have in Alabama, and we have in Bakersfield. And I'd love to buy all of them in one area or two areas, but it's a tough business to crack into, and we needed to be more opportunistic. And
mm-hmm.
the gentleman that runs that business is able to be more aggressive and travel a lot more. And we're looking nationwide in the MH space. And definitely as we get started, we want to try to make a footprint and show that we're a real player out there. And it's been an exciting space to be in.
What are some of the challenges that you face entering to that niche when you compare it to the multifamily space? I mean, because you guys have grown substantially, and you've got a big portfolio. You guys you've proven yourself in that space, and obviously there's very unique nuances that exist in the manufactured housing space that probably don't exist in the multifamily space. But what are some of those, and how have you overcome those challenges?
Yeah, it's a great question. So, to be honest, I've been wanting to get into the MH space for probably 4 or 5 years, and we've made some selective offers here and there, but we just never felt comfortable enough getting into it, just because it has all those nuances, and it's a similar business, but it has a lot of differences. So we recruited a top regional manager for a top company called Sun Communities to lead the charge. So we mm-hmm. brought him in, and it gave us a level of comfort because he was a top regional manager, oversaw 15 parks, and did a great job in boosting the NOI in those parks and keeping them occupied, et cetera. And so he's the boots on the ground, and we provide all the support services, but he really oversees the charge. And the whole space fell under our thesis of buying affordable housing, and as the home prices continue to rise rapidly, rents continue to rise. We just love the business. There's very few new parks being built. A lot of them are being scraped and redeveloped into higher, better uses, and
mm-hmm.
It's just, I think, I was blown away with the numbers that 20 million plus Americans live in a mobile home, and there's 45,000 give or take parks, and a lot of them are mom and pop owned still, and they haven't really been aggressive on keeping up with the inflation with the rents, and
mm-hmm.
just a lot of opportunity. I think there's just a ton of opportunity I think we've already broken into the top 100 owners, because there's not that many large ones. There's a lot of small mom and pop. So I think there's a lot of opportunity to really grow here. But to be honest, it was difficult buying the first one because we didn't have that track record. So it took a little longer to raise the funds from our existing investors. They don't really understand or know mobile home parks. They don't. If they live near one, they don't really see it or pay attention to it. They don't really know about the space. So it's a lot of education, hand-holding. But I think in the long run, I feel it's going to be as big, if not maybe even bigger, than our apartment business. So I'm really bullish on it.
That's awesome. Good deal. No, we are too. No, we love the space a lot. So I want to change gears a little bit, Keith, and I want to talk to you about the growth of your business. More specifically, some of the biggest challenges that you guys have faced as it pertains to the incredible growth that you've experienced over the past 9 years. I mean, 9 to 10 years. I mean, you guys, again, from basically zero to, I think you said 7,500 doors is what you've totally, is what your total acquisition number is. I know you've sold off about 2,500, but from zero to 7,500 doors in a matter of 9 years, that's a lot of growth internally. And I know you outsource your property management, but that still means a lot of internal growth and a lot of challenges and hurdles along the way. So talk to me about some of those biggest challenges that you guys faced when you're in that hyper growth mode.
Yeah, I'd say the biggest challenges is, I think personnel and the team you build is so important. So I think some of the initial team members were great for us in the beginning, but we sort of parted ways, and I think it's helped us grow even further because we've added new team members, and just having everyone be aligned and creating a good work environment. And this is our fourth move already. We kept outgrowing our offices, and it's all about the personnel and corporate culture and philosophies. And I think just maintaining that as you grow larger and larger is very important. Not forgetting where our roots are. I still feel like we're a tiny company, even though people say we're not. I still feel it, and I always want to feel it. Even if we're the largest, I still want to feel like we're an underdog, and we want to always be creative and entrepreneurial and have that in our DNA. So I'd say hiring, having a good staff. And it's funny, most of the people, we have around 17 employees now, most of them have come to us looking for employment rather than us outbound going, just because of our reputation, and they know it's a young and exciting place to work that's we're growing quickly. We're open to new ideas. We listen to everyone that has ideas here in the company. It's not like it's more of a meritocracy rather than just from a top down,
Sure.
me demanding things of people. And, people like working here, and it shows in their productivity. And so I'd say the challenges in the beginning were always like just people, which is in any business. And then what are the challenges? Right now, it's finding good deals to buy. I wish I bought everything in sight back then.
Yeah, right. No, I think we all say that, right? So
yeah,
how have you guys been finding deals? I mean, I'm assuming brokers play a large role in your acquisition strategy, both the multifamily and the manufactured housing side. Have you utilized any other out of the box type sources of deal acquisition other than brokers?
So for these larger communities, it is, like you said, pretty much dominated by the broker community. So I think what set us apart is our ability to close and not monkey around with retrading. And we've developed a reputation as great buyers. So we bought from some sellers 5, 6 times, 3 times. We've had repeat buys from the same sellers. So they are still like marketed. Some deals are widely marketed. Some are softly marketed to a few groups. So I feel fortunate to be able to be in those few groups that get the opportunity to see some deals. We've never done a totally off-market deal. I mean, I'm sure they're out there, but never like a principal to principal. There's always been a broker involved, and we've done really well with everything we've bought. So some are more competitive than others, but we've always stuck with our guns and not to where we don't feel comfortable on a pricing situation. We've had deals that have fallen out of contract because the first horse wasn't able to perform and we were number 2 or 3. And some deals we've won when we were 2 or 3 because of our reputation, not because we were the highest price. So, it's not always about pricing. We've sold buildings where we picked not the highest bidder just because of the reputation of the highest bidder, knowing that they weren't going to perform at that level. So I'd say in this space, reputation is key in the relationships with the brokers. The apartment brokerage space, some markets we're in have, as little as 2 or 3, big brokers that do most business. And even the bigger markets, there's probably only a dozen or so that handle like 100, 200 unit plus communities. So maintaining good relationships. And it's even smaller within the MH mobile home park space. It's only, because it's more of a niche. So just keeping on the top of the mind of these brokers and treating them well. They're, we treat our investors like gold and the brokers like gold because they really help us grow our business.
Mm-hmm. Yeah. So, what advice would you give someone that's looking to crack into either one of these businesses? It doesn't matter. You could base it on the mobile home park space or the multifamily space. But someone that's may they own a couple fourplexes like you did back in back in the 2008 era, but they're looking to step up to something larger. But they're finding it very challenging. Number one, where in the height of the current real estate cycle in a lot of these different markets, lots of buyers out there willing to pay more than the next buyer, and so very challenging to find good opportunities. And so what advice would you give to that new guy that's got a little bit of a track record but not much in the larger space, 100 plus units, and he's trying to build that relationship with these brokers and just finding a hard time being the guy that gets an opportunity sent their way? I mean, what advice would you give that guy that's getting started and wants to crack into the bigger space?
Yeah, if I was starting now, it definitely would cause me to pause a little bit, just because the best time to start most businesses are during recessions, and it's we've seen such a price appreciation. But that being said, it's all cyclical. So at some point, rents are going to drop, and values are going to drop. You look back, at least 50, 100 years, there's been so many recessions. It's caused by different things. So I'd say just gearing up to be ready to pounce. So get your ducks in order. If you don't have, get your liquidity up. If you don't have the liquidity, partner with someone that has liquidity. If you get your investors lined up, if you don't have investors, partner with someone that has investors, and just prepare for a pounce once it does change. Or if you find that needle in the haystack, a really good opportunity. I mean, it's funny, when we started, it was harder to raise money and easy to find good opportunities. Now it's like easy to raise money and hard to find good opportunities. But I'd say it's sort of switched. But that means we're probably, getting closer to the next cycle. But I'd say, just prepare for, a big launch or try to find that needle in the haystack, that a deal that really makes sense. And if you have that great of a deal and you're honest and you show your underwriting is conservative, like we've always been, people have capital and they're looking to place it, and they're not earning much in the bank in terms of interest, and stock market's at all-time high too, and been very volatile. And so there's always going to be people that have money to be introduced to real estate, and it's funny, most of our investors have pretty high net worth and they don't really have exposure to real estate other than they own their own home, and they're thankful for us because we provide that exposure to real estate, and that's been one of the better asset classes for their investments compared to other investments they have. So.
Okay, fantastic. Well, now I want to ask you a little bit of a unique question I'd like to ask every one of our guests. And so you've been doing this 10 years now, at least not as an entrepreneur, but in the real estate side of things. So knowing what you know today, because you've done a lot, if you go back into year one, back 2008, when your cousin brought you that first opportunity, and you give yourself some advice back then, what would that advice be? And I think I know what what your answer is going to be, but I want to hear it anyway. See if I'm right.
Don't be so picky when there's blood in the street. I mean, we passed on a lot of deals just because we thought they were a little too pricey or whatnot. And when there's blood in the street, I mean, you load up on
buy.
you back the shopping cart up or whatever. So. As we get later in the cycle, we're getting more picky. But I'd say don't overanalyze things. A lot of people have analysis paralysis, and with these little fourplexes, what was the worst thing that could have happened? I mean, we didn't have much to lose. We were young. I was still living at home, and there was just pure upside, and the downside was very limited, especially when the prices were so low. So I'd say you got to just take the plunge, and don't overanalyze. Sometimes people overanalyze things to death, and real estate. I love it because I'm not the smartest guy, but it's like you follow the protocol and buy well-located buildings and areas that are on the up and up instead of the decline. And over time you're going to make money as long as you can withstand the recessions. So it's not rocket science.
So I know you guys are primarily on the western half of the U.S. with your multifamily stuff. What markets are you actually in? Is it just in Bakersfield primarily, or are you spread out in multiple other markets as well?
Yeah, so for apartments, we were in Bakersfield. We just exited. We have a mobile home park there still. We were in Phoenix in a major way. We had around 2,000 units in Phoenix. We just exited Phoenix just because it's a very cyclical market, and B, to create that track record. We are in Reno, Nevada. We're in Portland, Oregon. We're going to be closing on a Seattle portfolio soon. So in Washington, Denver, Southern California, Salt Lake City. So we're in a lot of West markets on the apartment front. And the reason we did that is, there's a lot of markets that are great all around the country, but we have a small team, and we wanted to be able to, hop on a flight, do a day trip. And plus there's a lot of growth in these markets. We're looking for markets that have a huge population growth and job growth, and all those markets had those criteria. So yeah, we sort of focus on finding a market and then diving deep into that market and learning it, and then, pouncing with one acquisition, then two, and try to grow amass at least 1,000 units in each market, just because, for economies of scale. We're also in Albuquerque, New Mexico, which a lot of people raise their eyebrows. And being a contrarian, I like that market because it's slow and steady. And during the last recession, only I think one or two buildings went to REO, as opposed to like Phoenix and Vegas that got slammed. So I think as we get later into the tooth of this cycle, just looking for stable cash flow. And this building was in the best part of Albuquerque, and it was like 100% occupied, meaning that there was a lot of left on the table. Yeah, usually when something's so occupied, the rents aren't high enough. So looking to buy more there. And I like to geographically diversify for our investor base. I know some people that do really well just focusing on one market, but I think geographic diversity is good, as well as buying at different times in the cycle and stuff, just to protect us.
So in the MH space, you don't have as much of a luxury to be pick and choose in particular markets. Obviously, there's only 45,000 parks in the U.S., and of that number, there's probably just a fraction. I don't know that exact number that would actually even fit the size criteria that you or us might be looking for. And so, do you guys kind of make some exceptions to the rules as far as the underlying fundamentals you're looking for, like when you're buying a multifamily property versus buying a MH property?
Yeah, we're definitely, my partners, they want to focus on bigger buildings just because it's the same amount of time and energy to buy a small property as a larger property. And, we can make more money on these larger properties. And usually there's less competition. You don't have the same mom and pops going after the big stuff is the small stuff. So, But in terms of dollar purchase price, these mobile home parks are a lot smaller. Trying to get that up over time as we build our track record. And then, like I said, geographically, we have to be more open. Space count, instead of 200 units and up, mobile homes, we're buying maybe 100 pads and up. Trying to break into the space. And eventually we'll probably go towards that more institutional quality stuff as we create a track record, but we got to be more opportunistic in the beginning.
Yep, no, absolutely. Okay, well, good deal, Keith. Well, I'd like to enter into what we call the Gold Nugget segment of the show now, and we're going to wrap things up after this. And I'd like to ask, if you would, Keith, and you've already shared a ton of Gold Nuggets with us, but if you had just one last final Golden Nugget of advice or wisdom that you could leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last Gold Nugget be?
I'd say something that's missed a lot in our industry is giving back. And we recently created a 501c3 called the Gelt Foundation, and we're providing rental assistance for people that have historically been responsible renters but fell on a hard time and they weren't able to make a rent payment. They had a medical emergency, a car breakdown, and 60% of Americans don't have under $1,000 in savings. So these people are, a lot of people are paycheck to paycheck, and so we're giving back. We've always given back in our way, helping the communities. We're investing in. We've been involved in the boys and girls clubs in the areas we're investing in, but really creating. We're trying to create an association of responsible landlords, and provide this rental assistance for people. And we just started a month ago. We've already helped 4 families that were. A few of them were affected by the Hurricane Harvey. They lost their jobs temporarily and weren't able to make rent, and we helped them stay in their homes. And I think just the goodwill and giving back has always been part of our DNA, and I think that's helped us to be where we are. So I'd say giving back is very important to a successful business person. I
agree 100%, man. I love that, brother. Is there a website, or what's the name of that organization that you founded?
Yeah, it's called the Gelt Foundation. We have a temp website up. I think it's thegeltfoundation.org. And we've been taking as small as donations as dollars, and then as big as in the thousands of dollars from people we do business with, and every dollar that comes in goes directly to people in need, because Damien and I are covering all the overhead for the whole staff, accounting, legal, et cetera, at least for the first few years. So every dollar that comes in is going directly to the people in need, which is pretty cool.
That's awesome. Yeah, that's very cool, man. Thank you for doing that. And that's all we have, bud. Yeah, this has been absolutely awesome, Keith. I was, like I said in the beginning here, I was real excited to have you on the show and talk to you about, all the success that you've had over the past 10 years being in this business. And you're just a young hustler, man. And we were talking about this a little earlier before we started recording. You're 33 today. You've accomplished more than most will accomplish their entire lifetime, even if they're full-time real estate investors. So be very proud of that. You guys have done really, really well. And for those that are listening and that want to learn more about Keith and his company, they can go visit his website. It's geltinc.com. That's GELTINC.com. And I forgot to ask you, Keith, I meant to ask you in the beginning, what does Gelt stand for? What does that represent?
Yeah, so it's funny. My grandparents were Holocaust survivors, and I wanted to keep this language. It's called Yiddish. It's sort of a dying language, and I wanted a word that sort of resonated with a lot of people. And Gelt literally means money in Yiddish. And during Hanukkah time, we give these chocolate-covered coins that are called Hanukkah Gelt, and it just part of the ethos of giving, and I just wanted to, use some kind of cool Yiddish word, and that's sort of how we started that company with the name. And it's a simple and pretty easy to remember also. Yeah,
no, I love it. Good deal. Well, guys, I'll put that in the show notes as well as the link to Keith's foundation as well. And Keith, that's all we have, but I really appreciate you being on the show. This has been an awesome time, and I'll look forward to staying in touch with you, man. But until then, just get out there and keep kicking butt, my friend.
Yeah, you too. I really appreciate your time, and to all the listeners, thank you for listening, and we'll stay in touch, Kevin. Thank you so much.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.